Ladies and gentlemen, welcome back to the series Keep It Simple, Part 3. And today I'm going to talk about fair value gap. So let's get on it. Now, I'm quite sure that everyone here have heard about the term FVG, meaning fair value gap. And this video, actually, I'm going to teach you one of the simplest way to determine, to identify first fair value gap, and also to see whether that fair value gap uh is you're able to trade that fair value gap. So I'm going to try to teach you the simplest way. That's why this series is called Keep It Simple. I'm going to teach you the most simple way you can use fair value gap. And actually, if you use this video and you watch this video many times as you can, I'm sure you're going to pass those pre-firms. You're going to change your trading life forever. So please watch this video as many as you can. As many as you can. I'm challenging you, watch this video 5 times this week, and I'm sure you're going to change everything in your trading life. It's going to change everything. All right. Now, one thing to understand about fair value gap is not every fair value gap you see in the chart is uh is is likely to respect the way you want, okay? So not every fair value gap works. All right, so okay. Now, fair value gap, fair value gap is actually a three candle pattern where we see a gap between three candle pattern. The first candle, the second candle, and the third candle. And then between the first and the third, this here in between is what we call a fair value gap. All right? A fair value, a fair value, fair value gap. Now, now, all right. Now, if the first candle's wick and the third candle's wick do not meet each other, that is what we call fair value gap. I know most of you here know about this thing, okay? So I'm not gonna go deep into it. So fair value gap is just three candle pattern in which the first candle and the third candle do not meet those wicks, do not meet them. So if those wicks do not meet each other, that is what we call fair value gap. Although I always have misunderstanding between this word fair value gap. My students know, so I'm not going to talk about that. Now, we know that we can use this fair value gap as our POI or as entry, okay? Meaning, why do I say as POI? Because sometimes you may wait for the price to come in to that fair value gap and create another scenario for you to use as entry, or you can use as entry directly, okay? Directly. So that's why I'm saying you can use this pattern as a POI or as entry, okay? Now, what I'm about to show you will actually help you a lot, okay? So let me show you. Okay, I have three patterns of fair value gap. Three patterns of fair value gap. The first one here, the second, and the third one right here, okay? So this fair value gap, you can see we have a gap here. We have a gap here. See, that's a fair value gap. We have a fair value gap here. Okay, 3 candle pattern, leaving a gap between the first candle and the third candle. Now, these 3 patterns are traded differently. That's why I said not all fair value gap can be used. Okay, these 3 fair value gaps are traded differently, and I'm going to show you how. But if you want to understand this more, all right, go on and watch the video concerning candlestick and atom, and then go on and watch the video concerning the market structure. That's that series of the market structure. Go on and watch them, because it's going to add some sauce on it. Okay, so the first example here, the first scenario is a fair value gap, but we need, the trick here is to observe this third candle, this candle here, the third candle here. All right, this is the one we need to observe. And how are we going to observe? We're going to look for 3 things. First one, we're going to look the candle body, the body of the candle, the third candle. I'm talking about the third candle. And third, the second thing, we're going to look the closure. The closure. I don't know how to spell closure. So, all right, that's not my problem. Now, I'm going to show you, you can see actually how the third candle closes the third candle body. All right. So starting with the first scenario, whenever you see a candle, the third candle having a small body, and sometimes it can be a little bit big, but the wicks, the third wick, which is the FMD wick, is small. That means there was a consolidation in this candle. If you go to the lower time frame, you see a consolidation around this candle. Inside this candle, you see a consolidation. In this scenario, you'll see most of the fair value gap here respecting the price. So you can use this fair value gap actually to trade for entries. But if you see the second scenario here, if you see this third candle having a very big body, it's like the biggest momentum. If you see this, now when you see this big momentum in the third candle, most of the time, the fair value gap here doesn't work. We'll see the next candle opening and then performs a continuation. So when you see a fair value gap, but the third candle is big, you just have to look for continuation after the next candle opens. This is most of the time. You see this. It's very rare to see the price coming all the way down to the fair value gap and then going up. It's very rare. So in this scenario, just look for continuation. Do not bother looking for the price to come to your fair value gap. It doesn't work most of the time. The only fair value gap that works is when the third candle is small. The body of the candle is small. That's where we see most of the time price coming towards the fair value gap and then boom. But we have the third scenario where we may have a small body, but we have a closure which is a week-to-week closure, okay? A week-to-week. And not just week-to-week, but also the third candle closing with a different participants, meaning we have a bullish fair value gap, but the third candle is a sell candle, closing, selling candle. Here we have to observe three things or two things. First, look at the body size. If the body size closes at least 50% of the previous candle, this fair value gap will not work. We'll see price reversing. We'll see a reversal pattern. Or sometimes it can be a rejection here, but because there is something to the left that makes this as a structural rejection, for example, it can happen also a what? A reversal. But if the candle closes with a small body, okay? I mean, we're not 50% of the previous candle, but it is a week to week. Do not trust this fair value gap because you may see something like this, and then boom. So you may be taken out, and then price going to your way. So you have to observe all scenarios. But the only fair value gap that works most of the time is this first scenario. Small body, fair value gap. There now you have to see price coming to your fair value gap and then activate your entries. Boom. I don't know if you understand. So I'm going to show you some simple scenarios, some simple example, and then go on and practice this on your own. And then you see what I'm talking about here. And you see how easy it is to trade fair value gap. All right, now look at this one. Look at this one. We have almost like two fair value gap here. We can see this one here. All right. We can see this one here. This is also a fair value gap. And then we can see this one. This is also a fair value gap. But I want to talk about this last fair value gap here. Look at the way it closes. We have a closure, a week-to-week closure here, a week-to-week break, and then the closure of it of the candle is it closes below a sell. It's a sell candle, all right, and it is a week-to-week above here. So you can see how and what happened next. We were taken out. We were taken out. You see? See what this second fair value gap here. The third candle was big, so price did not come. It came later, but this is not the move that we were waiting for. But look at, we had a sort of a continuation, but we failed to close again here. That's why we have a very big move downwards. Same applies to this first fair value gap. See, the second candle is big. The next candle performed the continuation. So if you use this, for example, this is the daily time frame. All right, this is the daily time frame. If you use this, actually, it's going to help you in analyzing the market. It will simplify your analysis process in big time, you know. Let me show you another example. All right, look at this one. This one is the best example. Look at this one. We have the first candle, the second candle, and the third candle here. But we have this fair value gap in which price respected it perfectly. Why? Because the third candle was small, meaning there was a consolidation around this candle here. We had a consolidation, and then we had a manipulation entering in our fair value gap, and then distribution. See? See that? That is why I say most of the time, the fair value gap that works is when the third candle is small. And then when you see that, you wait for the price to come in your fair value gap. If it is the higher time frame, and then you see, you go to the lower time frame, you look for the entry inside that fair value gap, and then boom, see, the market went all the way up, all the way up.